Hi everyone, Dani Beit-Or from Simply Do It here, and I want to go over, explain a complex transaction we are about to do and actually partner with some of you on it, but it requires some explanation. I've put together a full page of explanation with FAQs, with steps, with numbers and everything like we normally do. It's right here, and you can see this website, um, or you can get a link for it so you can go through the details. But I think it still requires explanation because it's a complex deal. A complex deal many times are very lucrative or very beneficial financially, but we have to understand what's going on in order to feel comfortable joining into a deal like this one. If you are a beginner is someone has done no transactions or maybe one or two, I would say possibly consider sitting this one out and waiting for something like this in the future. So you're not obligated to watch this unless you want to. I just want to be completely kind of um, um, calibrate expectations. This may be a little bit overwhelming. If you are an experienced investor, this could be actually relevant for you for a couple of reasons. Number one, this is a group investing or co-ownership methodology. So that means about three investors. We hope to have up to two or three investors, pool funds together. I will elaborate on everything with probably a minimum investment amount, just about $60,000. So the threshold to get in for this one is about $60,000. So that lowers that aspect. Also, this transaction is going to be more handled by a third party because it's a group investment, which means less active involvement on your behalf. So some of our investors who own multiple properties and don't want to buy another property just because the financing is a hassle or the dealing with the ongoing stuff, with the property management and all this stuff, which is part of owning real estate. Even if it's only like an hour a month or something like that, still a little bit of a hassle. Do express their frustration that they would, if there is an opportunity to invest and to be even more passive, they would appreciate it. So this is one of those situations that you can consider taking a more of a passive position on the everything that's going on, the operational aspect of it, and I will elaborate everything. So let's start and dive into this deal now that I finished my kind of deal promo. So here's the couple of things. First of all, this is a single family home, 3 bedrooms, 2 bathrooms, about 1,600 square feet in outside Atlanta, Georgia. This is about 20 miles ish in a good suburb of Atlanta, Georgia, in a good section, everything checks very well with respect to the property itself. So this is where the property is. It is owned by a person, a family that live there at the moment, and they are interested in tapping or accessing equity they have in the property without needing to sell it or move. So the special circumstances here, there's a owner who would like to stay in the property without needing to move, and that owner wants to tap into their equity for whatever reason. However, the traditional methods of refinancing or loans or something like that are not necessarily available to them or not available to them, in good terms. I don't have any transparency to that aspect of their life. I'm just bringing this deal through our partner, who is the one who's working on those details with such sellers, right? So this is a very unique situation where owner wants to tap into equity without needing to move out of property, and this owner is also going to rent it back from the new owner, the buyer, us, and stay in the property for, we'll have a lease for 12 months. And after 12 months, they have the option to buy it back for a set price, right? So this is why this is a little bit complicated. And by the way, don't worry, I'll make it even more complicated than this. So just to simplify, seller owner wants to sell for a discounted price. So that means the buyer will have some equity, and all the numbers are on this page. Um, Rented back, listed back. So the person who owns this house is listing it back, and then have an option to buy it in 12 months at a certain price point, and a fixed at a set price point, right? So we got uh, seller, owner, tenant, option to buy again. So that's the deal structure. In order to make it work, the way it's set up is not only that we have a seller owner becoming a tenant with an option to buy within 12 months, that person will leave their mortgage and mortgage terms in the property. So that means if we are coming in as buyers, we will buy this property and transfer title to us, and while title is being transferred to us, the mortgage and mortgage terms stays the same. This is what's called a subject to mortgage or purchase. Subject to comes from subject to existing mortgage, right? So mortgage terms uh, will stay, with the property, the same thing that's already happening. So there's no, for that reason, there is no actual financing, traditional financing here. We're not going to go to an appraisal. We're not going to go um, through qualification, credit score, all of that. We are just kind of switching title and taking over, with the possibility that the seller will buy it back in 12 months. So that means also zero vacancy, and the seller, now tenant, is considered to be a very quality tenant, because this is their house and this is what they're accustomed to, and they live there and they know they are looking to buy it again in 12 months or so. So it's kind of super creative concept altogether. So first of all, we understand the setting of the transaction: owner seller becoming a tenant with an option to buy. Then we understand the financing aspect, where the existing mortgage with the existing mortgage terms, which I think it's 4.25 interest rate, stays in place. Mortgage balance, all the numbers are, I'll review them, are on this page that you have in front of you, so you can dive into the specific details. Now, purchase price for this property is 200. I'm going to use round numbers here. 270,000. The market value of this house is 330, 335. So we have some equity, but $60,000 worth of equity from day one. Since we are looking to buy it as a group of investors, which I will explain in a moment, that means we're looking to have simply do it as one partner, and three investors that each are going to bring $60,000 into this investment. $180,000. We need about 165 to buy it. So 165, 166 is to buy the property itself. We have a mortgage balance of about 100,000 plus the equity or the down payment of 160 or 165. That brings it, again, I'm rounding number, to 265 or 268, just because I'm rounding numbers here. And that is the amount that's required for this property. So we are buying it with subject to existing mortgage of $102,000. And of course, we want some closing costs, inspection, maybe some repair, some reserve. That's why we are wanting to have a bit more than the existing, or the required amount of 165. So we have a buffer, operational buffer. Now, we talked about the seller. So the seller has an option. The seller becoming the tenant has an option to buy it in 12 months for a set price of 285,000. So that's about 16,000, 17,000 more than what we purchased. So that means if everything goes according to this plan, and the seller, owner, tenant now buying it back in 12 months, then we will only make on this deal around $17,000, which is, I would agree, far from being exciting. It's not bad. It's not really exciting to begin with. Part of this transaction and the way we perceive it is that there's a very likely or highly likely that this person is not going to be in a position to buy it back in 12 months, which will give us the opportunity to really benefit from this property or this transaction. So let's go on what are the exit options here in this the different exit option if should you want to join this deal. So option number one, like I said, not ideal. Okay, tenant moves out. Sorry, seller owner slash tenant now is buying it back at a fixed price, and we make about $17,000 ish, and it's okay. Not exciting, but okay. Option two, the same person comes to us and say, you know what, I want to extend that option to buy that property, in which time we can decline, we can negotiate and say, not a problem, but now the price is going to be, I don't know, $10,000 more or whatever we determine, to $20,000 more, and determine time, and maybe we charge some option fee, or in the meanwhile increase the rent. So there's definitely open up for negotiation how we're going to extend, should we want to extend, right? We don't have to. The seller, this seller owner's now tenant says, you know what, forget about the option. I do want to stay in my house. How about I will extend the lease, traditional lease, for another 12 months, and the option goes away. Okay, we can do that too. Of course, we have to make a decision based on multiple factors, but that's definitely a possibility. Option number four, this seller owner slash tenant decides they move out, and we are just going to put this house back on the market. If the house is back on the market for leasing, we can go in two different directions. Direction number one, traditional long-term rental, like we've been doing and like we know how to do very well. That is not a problem, right? We can just do that, maybe put it back on the market. By that time, maybe collect $2,000, $2,100, whatever the market rent is. Option number two, and we don't have to decide, we were not going to decide it until we get to that point. Option number two, we are started a new investment program at the moment in Atlanta, but with a plan to extend it everywhere, that rents houses in a hybrid format. Hybrid format is a combination of midterm tenants and short-term tenants. Midterm tenants are usually people like going through some insurance situation with their house, and they need to vacate their house because it was some fire, some some plumbing situation damage, some whatever, and the insurance actually pays them for rent until they fix their house. It can be a corporate housing. It can be someone who comes for a few months for a military assignment in his family. They're coming with a family, or someone that comes in for training for several months, or all sorts of people that are looking for not necessarily 12 months, but are looking for a furnished property for 2, 3, 4, 5 months, and they're willing to pay much more than traditional rental because it's furnished and it's short term, and many times someone else is paying the rent for them. I don't want to dive into it. That's a possibility that we can consider. The benefit of this possibility is just much, much, much higher cash flow with the property, but it does require to invest a little bit more money in furnishing, furniture, design, etc., to make it nice. Not a lot more, maybe $25,000 more, depending on the size and what needs to be done. But that is a possibility. So we have two options. Should the tenant vacate, traditional rental, hybrid rental, we will decide how to go about it when we get closer to that point. Also, when the current seller owner slash tenant moves out as a tenant and doesn't buy the property, the mortgage that we got with the property, his mortgage or her mortgage, stays in place. So that means we're still going to benefit from the 4.25% in this incident and the mortgage balance of $100,000, and that is not going to go away, or not going to go away for a few more years. It really depends how everything is negotiated on a per deal basis. So we still have that mortgage in place, so we don't have to do anything about it. The one thing that we can do at some point in the future, let's just say 6 years have gone by and we rented it and we own it and it's doing nicely and appreciating, and we have all the regular real estate investment noise in the system kind of a thing. In that case, we can decide that either it's time to sell it, we can decide it's time to refinance and get a better rate or a new mortgage and pull cash out so we can see some cash while keeping the property. We can explore different options. It all comes down to what's the economical setting in terms of what's the rent, what's the cash flow, what's the how much equity, what's the interest rate, etc. So we can make a determination until at a future point of time we learn better what's available for us and what's the best alternative or option to choose. But that is an option. Anyone who's looking to join us on this transaction should probably plan for no less than 5 years. I would say closer to 10. So this is not a quick kind of a turn. Let's get in and out as quickly as possible. It's not a flip. The whole point of this transaction is to create a transaction with good mortgage terms while interest rate is pretty high out there, with interesting or creative financing option, with a tenant, with a good market. It's kind of a lot of benefits. Plus, one of the most beneficial aspect of this deal is that when we buy this house for $270,000 and it's worth $330,000, we already have about $60,000 worth of equity built into it. So from day one, we already have equity. And that's good for hedging, and that's good for if we are looking to do something with it, let's just say in 3 years and not wait for 6 years, for example. So this is why what makes this deal very interesting. Again, I'm emphasizing, if the seller / tenant execute their option after 12 months, all of this is being very theoretical, and it just turned out to be an okay deal, nothing exciting. So that's the quote unquote risk we're taking here. There is one other risk that I want to emphasize, or primary risk, when we're doing this kind of a transaction from the financing aspect, and it's important that everybody who listens and interested, and I'm sure I'll talk to you in person about it, is the aspect of the financing. So this kind of financing, a subject to, is done without the mortgage lender permission, right? They will get notified about it, but we're not asking for permission. Now, most, or I would say all mortgage lenders have a clause that says it's in their right in the mortgage agreement that if there's any change to the title of the property, it's in the right to call the loan, right? They can demand that it will be paid off immediately. That is something that it's well-known risk, or now it's a well-known risk when you do a subject to transaction. The chances, or historically, in my 20 years, I've only seen 2 letters that were a bank made, called the loan on a specific property in my entire career. So 2 letters in 20 years, 20 some years that I've seen that, actual a bank calling the mortgage. So that is a risk. There is a way how to navigate this risk. Remember, the mortgage amount here is $100,000. So there are ways how to navigate this risk. But I just want you to be aware that we are not seeking permission. We are doing it under the working assumption that lenders historically super rarely, execute that the right to call the loan, right? So if you are doing this deal, you got to understand that this is part of it, right? If you're not comfortable with it, this is not a deal for you. I have done it. I have personally, by myself, without any partners, did a deal like this, and that was a risk I was willing to take, right? That something like this would happen. So just want to put it out there. Also, I want to mention that The way we structured this deal, that we need about $180,000, of just a little bit short of 180, is we are looking for three investors, each to put about $60,000, or just rounding up to $60,000, and to be partners in this deal, where we're going to create a trust, and the trust is going to take ownership to the property, and every one of those investors are going to be beneficiaries of the trust. A trust is a different mechanism than LLC. It's just a different way how to go about it. We can always consider doing it through an LLC, but the reason for doing a trust is, one of the reasons to do a trust is exactly to get less attention by the mortgage lender when we are changing the title from the current owner to the trust, and you are going to be part of that trust. The trust is going to have a beneficiary. Trust has a trustee. It's a whole different, let's just say, playground. I'm not going to dive into it. There is some information about it on this page. So here's the thing. Let me recap everything. We have a deal in the suburb of Atlanta for about 270,000, where the owner seller is going to rent it back for a year with an option to buy it in 12 months. And during those 12 months, they live in this property and they pay rent. Actually, the rent is being paid upfront as part of the escrow of the transaction. You can join us with an investment. We have only 3 spots here on investments of $60,000 and become part of the trust that's going to buy this property, right? So it's going to be a $60,000. You are expected to be involved, but expected not to be actively involved, because there is a third party that will manage the operation. We call the operation manager, someone who shops for insurance and follow-ups with the tenant and coordinate whatever is necessary. If there is a property manager, then they are the person who navigates all the situations, all the ongoingness with the property, right? So that's how it's set up. You are expected to be more passive, not completely passive, more passive. There may be opportunities you will need to come in and say, here, express your opinion regarding a decision, something maybe with a large financial impact. You are expected to come in, or at least be okay with this being a long-term investment. This is not a short-term investment. This is not you coming in and waiting and looking to do a flip or short term within a year or two. While you have to remember that if the seller owner slash tenant executing their option in 12 months, we're going to be done with this deal within 12 months. So this is what I wanted to tell and explain. I'm sure if you have more questions or specific questions, or want to be part of this deal, let us know, get in touch with me, go to this webpage, read the details, the numbers, the financials, everything. I really try to put a lot there so you can spend a few good minutes in order to better understand the transaction, ask me questions about the subject to, or the trust, or the deal itself, and see if this is relevant for you. We are hoping to secure 3 buyers in the coming days. Thank you for taking all this time. We're probably good 20 minutes, and following and staying on focus on all these multiple components of one transaction. Thank you very much. Talk to you soon, I hope. Bye-bye.